There's been a lot of chatter over the past couple of months on whether or not we're in an index funds bubble. How would you know, and is there a hack we can use to sort it all out? Okay, so the argument goes like this. Index funds are so popular that people are investing in them too much. This, they claim, is distorting market values and creating a market bubble. So how can an index fund distort market values? Let's break this claim down in its very simplest form. When you buy an index fund, you're getting every stock in the market that index fund is mirroring. Thus, the theory goes, you are forcing that index fund to purchase both the good and the bad stocks in that market. Whereas the good stocks deserve to be rewarded and purchased and have its stock price driven higher, the bad stocks should have never been purchased in the first place, thus artificially raising the price of that stock, so they say. On the surface, this claim does sound logical, so let's test it. So this claim infers that if I went to a smart broker or portfolio manager, they could use their brains to purchase just the good stocks and keep the bad stocks out of your portfolio. Because the claim is that index funds are dumb or agnostic and blindly purchase both. Sound familiar? This has been the promise of Wall Street from the very beginning. Pay us money because we are smart and we can pick the winners for your portfolio. Problem is, the data just doesn't support this claim. Over 80% of managers underperform their indexes, and this number goes as high as 98% in some case studies. What this means is we can flip this argument right back onto managers. They actually pick fewer winners and more losers than the index funds. This claim falls flat on its face. And I'm calling BS on this one. Using this math, the managers actually cause more distortion than the index funds. Case closed. The Buttonwood Society, or the old model, is simply threatened by a new model that's being ushered in by the internet and index funds. Their claim sounds smart, but it fails under testing. Let's talk for a minute about stock market bubbles and crashes. Are bubbles and crashes good or bad? I would like you to think of bubbles as bull markets and crashes as corrections that lay the foundations for the next rally. Bubbles and crashes are the natural cycles of a living stock market, just like you and I breathing. Markets continually surge and contract. This is healthy. If they didn't do this, they'd be entirely predictable. They would be boring and you would only end up getting the risk-free rate of return, likely around the rate of inflation. Depending on how you define it, markets crash all the time. To make this point, when was the last crash you remember? 2008, 2002, 1987? Well, what about the crash of 2011? There was a 5-month period where the S&P 500 fell 21%. Or what about the crash of 2018? There was a 3-month period just last year where the S&P 500 fell 19%. The bigger point is this: who was smart enough to sell in September of last year and buy back in December? No one. Well, maybe 1%. But nobody makes these calls over time in some predictable pattern you could follow. The source of the most recent noise on bubbles originates with portfolio manager Michael Burry, a very smart guy. He's worth about $300 million. He correctly called the subprime bubble about 10 years ago, so he has a lot of credibility. You might remember him from the hit movie The Big Short from 2015. He was played by actor Christian Bale. Michael made a fortune betting against toxic securities during the financial crisis. So Michael made 3 great points in his interview. Number 1, small caps do not have the trading volume to handle large outflows. There's a lot of index money in relatively small companies whose shares are not frequently traded. This is a liquidity risk. Number 2, index funds that use derivatives also pose a liquidity risk during stock market crashes. Number 3, the most popular index funds are market cap weighted. Market cap weighted indexes overweight the largest and fastest growing companies within a market. This means those indexes are highly concentrated in those types of companies. My response to these 3 points are this. Number one, make sure all your index funds are not market cap weighted so you don't find yourself overweighted in one segment of the market. Number two, focus on large cap index funds that have the daily trading volume that can handle heavy selling. Number three, avoid index funds that use derivatives or leverage to track their indexes. Look for index funds that only purchase the stocks of the underlying index. You can check the index fund's holdings to make this determination. So how do we hack an index fund bubble? First off, enjoy them. Congratulations, you are in a bull market. Number two, crashes. Enjoy them as well. These are healthy corrections in the market that will lay the foundation for the next rally. And remind yourself that it's a ridiculous claim that you could have sold out at the top and bought right back in at the bottom. This is a dream world created by the people who make money every time you take your focus off the long game and start to play their short game. Even stock market wizards cannot predict and beat these natural stock market cycles. How do I know this? Just check the record versus index funds. This brings me to your final hack. What would a true index bubble look like? The only time you would need to reevaluate your index holdings due to an index bubble would be if managers start beating index funds. Let me say that again. The only time you would need to reevaluate your index holdings due to an index bubble would be if managers start beating index funds. This would be your signal that managers have pulled it together and are creating enough value that you should start looking at rewarding them with your investment dollars. Until that time, we are all in on index funds. Remember, we don't think index funds are just popular products. We believe index funds are replacing Wall Street. Every time index funds capture market share, the old model loses market share. These people are very threatened right now, so they're gonna make a lot of noise on the way out. The old model wins by getting investors to focus on the short game. Their profits are driven by clicks and traffic and trading, so they will do anything they can do to shock and worry you into getting your attention. Ignore this noise. Understanding this is key to accelerating through this transition period instead of getting sucked back into an old model that no longer works. We project the Wall Street that you grew up with will completely disappear by the end of this decade. The internet and index funds are enabling investors to take back control of their financial lives. These are exciting times. Welcome to the age of the investor.